Call Ratio Backspread, presented by Tackle Trading. Tim Justice here from Tackle Trading, a coach and the COO of Tackle Trading, here to teach you a strategy called the Call Ratio Backspread. This is an advanced to intermediate option strategy that involves two different transactions to build one spread transaction. Now, when you're doing a Call Ratio Backspread, what you're going to do at a bare minimum is sell -1 call option at a lower strike price and buy +2 call options or more options. You can do 3 or 4 or 5 at a cheaper priced option, which is going to be a higher strike price. Both strikes should be in the same expiration month. The strategy has unlimited profit potential, limited risk, and is generally used when a trader is aggressively bullish on the underlying chart. It's an aggressive bullish trade. Now, it does have some mitigating risk factors. You'll see that on the risk profile. It carries a positive delta, which means you want the chart to go up. A positive vega, which means a build in implied volatility, will benefit the trade. And a negative theta, which means time decay is going to hurt your trade. If it just sits in the middle is where the worst case scenario is for a call ratio backspread. Now, the construction. Sell an at the money or in the money call, usually higher delta, 0.50 delta, 0.70 delta, 0.90 delta. Higher delta call options are the ones you're going to sell. Buy an at the money or out of the money call at a cheaper delta and a cheaper price. A -1 + 2 or a -1 + 3 construction is very common in terms of the ratio of the options. Generally, traders tend to want to look for a net credit from the total transaction. That's how they determine whether or not they've got the right spread or not. 3 months or more is common in the trade, not mandatory, but more time usually. And generally, this is a position trade, and you should position size according to the risk in your portfolio you're willing to take. Management, your stop loss. Because you're dealing with two different options, you have a complex scenario with stop loss. Generally, the risk is set based on theta and based on the way you've built the spread. Many traders will forego a stop loss and use alerts to manually manage this trade. If you're going to use a stop loss, learn how to use advanced orders, contingencies, and make sure you know how you're going to get a fill. Set a target based on the chart. You can also set a target based on your long strike prices, depending on how you build the trade. And be aware of events. Obviously, you got to know if you're going to hold through earnings or not on a strategy like this. You have to have a plan for that. Risk profile is going to look like this. This is a call ratio backspread. So let's say that you buy 2 or 3 or 4 75 long strike calls and the stock is at $71. You then sell the 65 short calls in the money. What that does is it creates an open-ended profit zone on the top side, a loss zone in the middle, and also a profit zone on the bottom side if you generate a credit. So the characteristics of this trade are it's really good if it goes up, it's bad if it stays in the middle, and you can deal with it if it goes down. You shouldn't make a big profit on a drop in general. Usually the trade is designed to be bullish. That has been our Call Ratio Backspread trading glossary tutorial. Thank you for joining us, tackletrading.com. Get in the game, get over there, become a part of what we do. Join our community. We have all the different social medias, Facebook, Twitter, Instagram, and our YouTube channel. Like, subscribe, and attend our shows here as well so that you can get an idea of what our coaches bring to the table.